Okay, I'd like to go through two sets of just bare bones transactions, one where we purchase merchandise for sale and next where we sell it. Okay, so first we purchase merchandise that's worth $10,000. Okay, that would be the selling price from a vendor for $6,000. And our terms are we can take 2% if we pay it in 10 days, but the net amount is due in 30 days. So first we record the purchase, increase merchandise inventory, and increase accounts payable, credit accounts payable for $6,000. And next we record the cost of goods sold, remove the merchandise from inventory. So cost of goods sold is on the income statement. That would be $6,000. And we just put the merchandise in here. Now we're taking it out. It cost $6,000. All right, and now we've got two options here. We can either pay for it within the discount period or pay it after the discount period. Now, if we're able to take the discount, I'm going to take the entire amount out of the payable. Okay, that $6,000 went in. The whole $6,000 will not be due anymore, so we take the whole $6,000 out. Then we record I goofed. We record a purchase discount of 2% of $6,000 or $120, and the net amount we would receive in cash, $58.80. Okay, makes sense? Now, if we miss the discount period, then we're going to decrease the payable for $6,000 again, but just credit cash will have to pay $6,000. We won't get any discount. All right, so that's one way to evaluate how well a department is doing, is see how they're doing on their discounts. Now for the sales transaction, let's say that this is the sale. Okay, first of all, let's say that this merchandise that was worth merchandise, let's say the cost here. Merchandise that cost $6,000 is sold for $10,000 on account with terms of 210 net 30. So a 2% discount if we pay for it in 10 days, but the net amount is due in 30. So first we record the sale. So increase accounts receivable and increase sales revenue. Okay, so accounts receivable would be 10,000 and sales revenue would be recorded for 10,000. And next, this is another one that recording the inventory that was sold would be just like this entry. We're going to increase cost of goods sold and credit merchandise inventory by 6,000. And then if we receive the customer's payment within the discount period, we're going to take the entire amount again out of accounts receivable because it's satisfied. Okay, it's done. The amount of sales discounts on this would be $200, 2% of $10,000, $200, and the cash that we would have to that we would receive from the customer would be the difference, $98.80. Okay, now you can see our total debits equal to our total credits. Be careful with your amounts here and just give it a sniff test. Okay, look at it. If you get $1,000,000 here, then something's wrong. Okay, now if we receive the customer's payment after the discount period expires, then we'll get $10,000 in cash from the customer, and we'll again take that $10,000 out of the receivable. Okay, so these are just bare bones entries where you can follow the flow of the money through the accounts. Okay, whether you're on the purchasing side or the sales transaction side. Okay.